let's bring in our next guest on the show then. Nikhil Ranka, CIO of Equity Alternatives at Nuvama Asset Management is joining in. Nikhil, great to have you on. So the market in a bit of a funk, so to speak, kind of stuck. But, what's the sense you get? Looking at earnings, what is your assessment? Are we indeed poised for an earnings takeoff? Or should we just be happy if we don't get more downgrades, if we can do at least 9-10% this year?
So, good afternoon, Surabhi. If you remember the last time I was on the show, markets were closer to 25,600 on the index. And we said the best case is that markets either time consolidate here or we correct till 24,800 levels, because on an FY27 basis, the fair value of Nifty itself was coming closer to 26,000, 26,200. And we've seen markets correcting 1,000 points from those levels. Now, if you actually look at it, 2-3 things have happened. One, inflation has come down, because of which, if you look at it this year, most likely our nominal GDP growth will be in single digit. And our markets have tracked the nominal GDP fairly closely in terms of returns. And even if you look at some of the macroeconomic indicators, be it electricity demand, auto sales, cement volume growth, for most of these macroeconomic parameters, what we are seeing is a single-digit growth. And therefore, my sense is we will have a period where, markets will be dull and range-bound for a fairly decent period of time, say probably next 2 quarters. And then from Q3 onwards, probably as markets start factoring in FY28 numbers, we roll over to FY28. From there, we should see markets take off. My base case is that for the next 2 quarters, markets will probably consolidate in this 24,500 to 25,500 band. Probably Q3 of this year is somewhere where we expect that markets will start moving higher.
Nikhil, hi. Lots of question marks surrounding the business model of IT. Just because IT companies did well over the last 2 decades, can they continue to re-engineer themselves and come out trumps at this current transformation juncture that they're in? What is your view? Because people are questioning, the existential crisis in a way, or they're saying it could be in a structural funk. Growth could be in mid-single digits over the medium term.
So, good afternoon, Reema. My sense is, Reema, our IT companies have been fairly resilient in terms of engineering their businesses models as and when the situation has demanded so. If you look at it, when we were at the peak of the tariff crisis, the prices that we are seeing on large cap IT names, probably TCS closer to 3,000, Infosys closer to 1,400 levels. We saw that prices when index was closer to 22,000 odd levels. And at that point of time, 2-3 things were not clear. One, whether FY26 will be a growth year for IT companies. And second, what sort of margin impact that these companies will have to take. As we have traversed through the 2 quarters, what we are seeing is, one, clearly things are not as bad as they initially seemed to be. For most of the IT names, FY26 will have dollar revenue growth, maybe in low single digits. And margins also have been fairly stable in that sense. And if you look at valuations, most large cap IT names are now down below 20 times. If you look at the consensus EPS for TCS closer to 153, 154, Infosys closer to 75, 76 rupees, all these names are now starting to trade below 20 times. And my sense is, from these levels, the absolute downside in these names clearly looks very, very limited to me. 2-3% more. And I don't think beyond that you will see. And the point is, the bulk of the FI selling that we have been seeing in the last 15-20 days has been concentrated in IT names. And therefore, we are seeing that move on those stocks. My sense is, once the selling ebbs, we should have some bounce back on IT names. They should head back 5 to 7% higher from these levels, with probably 2-3% more downside from these levels.
All right. Hi, Nikhil. Good afternoon. So IT is something that you like, various arguments, right? You look at the dividend yield, you look at the free cash flow yield, and you'll say, okay, it's a bullish argument. Or you look at the premium that the IT index trades at in comparison to the Nifty. It was around 30%. At the peak, it's 50%. It's come down to around 14.5 to around 15%. So various arguments supporting it out there. But the other pillar of the market, you're saying the Nifty bank can still correct 5% from here. Tell us the rationale.
So Nigel, if you look at the commentary from most of the banking names this quarter, two, three things have happened. If you look at the NIM decline that has happened this quarter, the commentary has been that the first rate cut of 25 bips has been completely passed through. The second rate cut of 50 bips, only a part of that has got passed. So Q2, again, for most of the large banking names, will see NIM decline to the extent of 10 to 15 basis points. And on the asset quality side, if you look at, whether be it Axis, Federal, everybody is starting to see some deterioration on the retail asset quality. So a combination of these two things would probably mean that banking names can at best have single-digit earnings growth in FY26 because your pre-provisioning profit growth itself will be in single-digit, and if you have some increase in credit cost on top of that, then double-digit earnings looks extremely difficult from current levels. And therefore, my sense is there could be 3-5% more downside from these levels in banking names. And post that, both IT and banking will be at multiples from where it will be very hard to build incremental downsides. And therefore, as I said, the base case still remains that 24,500 should hold for the markets. In an extreme case, we might go down to 24,200. But given the data points that we have now, doesn't look that we will go below 24,200.
Okay, all right. Just one more point with regard to cement. It's had a horrific last 1 year, but the stock prices didn't correct that much. However, there are green shoots now. Pricing, if I look at it, July to last July, it's up close to 8%. So there's some recovery on that front. If the economy is going to recover, the second half of the year will look good on volumes. Your view on the stocks are then, what do you like? JSW Cement, I was speaking to Parth Jindal yesterday, and he was sounding very optimistic. He would actually be lucky to come this year rather than last year, because last year, the industry itself, there was a lot of pessimism out there. But this year there is hope, and that could explain why he's coming at premium multiples. Let's see how the issue goes, but your view on cement.
So Nigel, the only sector where we have seen some sort of earnings upgrade or earnings beat this quarter has been cement. Now, the good part that has happened for cement is if you look at the overall industry of close to 650 million tons, almost 350 million tons is now consolidated in the hands of two players, Birla and Adani in that sense. And we saw this same thing happen with telecom also, that, as the industry structure move towards more oligopoly, pricing is something that starts looking up. My sense is the same thing will start happening for cement also, and incrementally the flow through to EBITDA is extremely high even in case of cement, because the costs more or less are pretty fixed in nature in that sense. And coal obviously is not seeing any upside to that extent. So therefore, as the industry consolidates and we have some price hikes towards the second half, because Q2 obviously is a monsoon quarter, so one cannot expect large price hikes that will come through in that quarter. Q3 onwards, my sense is the pricing will start moving higher, and for a lot of companies, then 1,000 rupees per ton will more or less become a base. And the industry will start looking to move towards 1,400 to 1,500 rupees of EBITDA per ton. We've clearly been hearing from con calls of most large cement companies that 1,500 rupees per ton is a number that they want to achieve over the next 18 to 24 months. And that should lead to some sort of excitement on the street for cement names. And therefore, we are positive on cement companies from these levels.
Nikhil, thank you very much for that. That's the